So another article touched upon this in the New York Times. Just wanted to read a quick selection of this article here. It's a little older. It's from July, but it addresses what I mentioned earlier. It says in May, FINRA filed a complaint against Dave Lerner Associates, a broker-dealer in Syosset, accusing the company of aggressively marketing $300 million worth of shares of the non-traded Apple Hotel REIT to unsophisticated and elderly investors without telling them that the income from the stock was insufficient to support the dividends, which is something I mentioned earlier. And Lerner has called the charges baseless. But it's interesting how that plays out when you consider the fact that people receive statements with their shares being suddenly unpriced. So we have yet to see how that plays out. Now, it's also important to understand that these REITs, the providers, they're aware that people might want to redeem or take their shares out if market conditions turn against them or if they get nervous. And what they do is they actively limit redemptions, quite simply. And when they feel that they want their clients to stay in for a long period of time, they will implement a strategy whereby you may only redeem 5% a year. So if there's $100 in the REIT, let's say in total, they'll only accept $5 in redemptions in any given year. So you have to be the first in line or you're stuck with your investments. So not only is it not traded, meaning you cannot sell it to somebody else, the REIT provider in many cases will only buy a certain amount of shares back from their clients. This is actually a very dangerous situation because if there's trouble, as there has been in many of these securities, it's very difficult to get out of it. So you're not even going to be getting a discounted value for your shares. You're just not going to buy them back. This article also seconds the notion of the high fees. It says it could include high upfront fees that lower the value of investment by as much as 17 cents on the dollar. It says one common sales tactic we object to is the suggestion that they are eliminating volatility simply because they don't tell you what the value is, said a lawyer for the SEC's Corporate Finance Division. It's not that it's not volatile, it's just that you don't know it. And that seems to be the case, and it plays out in so many situations where investors are just caught off guard that it's really unnecessary. They compared the returns of the Wells Real Estate non-traded office REIT with the publicly traded sector when one of the Wells REITs went public early last year. So this is an interesting comparison. It says, okay, let's evaluate what the actual differences are between the non-traded REIT and the traded REIT, and this is what they found. Non-traded REITs are required to either liquidate or list their shares on an exchange within a specific period, usually at least 7 years. Investors in Wells got no return over the life of the trust because they paid fees amounting to 16%. In addition, the trust paid $175 million to acquire an advisory company made up of its own executives. It's just shocking. It never ceases to amaze me. In the same period, the average total return for traded office REITs was 6%. So it just goes to show you right there that the difference is startling. And the only thing that's keeping investors from investing in the traded REIT versus the non-traded REIT is the story told to them by their broker, which is unfortunate. So it's one of those situations where commissions and excessive fees are driving a market and leading investors in a place where they're not really all that much better off, unfortunately. As if all that is not shocking enough, it also goes to mention the Apple case with David Lerner. It says that these REITs sometimes borrow money to cover their dividend. So whereas a publicly traded company, they might earn money and pay dividends based on their earnings, if a company is borrowing funds to pay out, that means they're going to have to generate even more income in the future, and it remains to be seen whether any particular investment is going to be able to do that, especially in the environment that we're currently in. So that was a few stories on non-traded REITs. In response to all that has happened so far, FINRA was actually kind enough to provide a disclosure for investors, which is quite lengthy and actually quite good. It shows the risk factors, it shows all of the fees that may be charged, and it explains the whole idea of the REIT in very clear terms. The only unfortunate aspect is nobody will read it. Investors are notorious for responding to the story that they've been told by their financial advisor or their broker, so nobody is actually taking the time, I would bet, to read this, unfortunately. But it does disclose the fees, and to FINRA's credit, I have to say that this is quite a good disclosure. So in summary, it says A 15% front-end fee on a $10,000 investment means that only $8,500 is going to work for you at the time of investment. If you have 15%, of course, taken out from $10,000, you can't earn 15% and be back where you started. Of course, you have to earn a lot more to be back at 10,000, which is quite a feat in today's market. And it's a market that's increasing rapidly. More and more investors are jumping at the chance to buy these securities. And I have to say, the sales pitch is incredible. Sales pitch was great. They have some really good people out there as far as salesmanship. As far as protecting investors, though, it's quite a different story. And I'll leave it at that as far as non-traded REITs go.